Welcome everyone to another Smart Money Circle show. I'm Adam Sarhan. With me today is Bill Gebhardt, who's the founder of 10Dynamics and developer of TAD, which is their proprietary technology that's developed for a systematic approach to trading multiple markets and multiple asset classes. Bill, thank you so much for taking the time and welcome to the Smart Money Circle.
Thanks, Adam. Great to be here. Really appreciate it.
So, Bill, I always like to begin. Can you tell us a little about your journey and how you got to where you are today?
Sure. I guess well, it depends on how far back we go, but I ended up getting, I guess, fascinated with finance after studying engineering as an undergrad, and did chemical engineering without ever realizing what chemical engineers did. It wasn't until I graduated that I suddenly thought that working in an oil refinery might not be my cup of tea, and that got me into finance, and I ended up in Chicago for a bit on the Chicago Board Options Exchange, and I worked as a clerk there for an options market maker back, this was back in the early 90s. So it was kind of the heyday, the open outcry, and was a fascinating. There's 100 stories there about what it was like to be on the floor back then. And I just worked as a clerk and got the bug, but realized I wasn't cut out to be a floor trader, and then had a couple other jobs, but ended up back getting a PhD in finance because I really wanted to delve, I guess, a bit more into the kind of mathematical side of finance and what we're doing, and see if I could tie the trading back to some sort of more rigorous approach, I guess you'd say. And so yes, I did a PhD in finance in Cornell. Had thought about being a professor, but then ended up back in industry, working for an energy company down in Houston. It was Koch Industries that became part of Entergy Koch. And that took me to London, where I worked for Entergy Koch, which was bought by Merrill Lynch. And there I was doing like energy trading, and was responsible initially for the fundamental quantitative research group that we had to underpin the proprietary trading that we were doing in energy. And then eventually ended up at Deutsche Bank, heading up the European energy trading desk. Did that for several years until things changed in the world in 2008, and ended up starting a company with some of my colleagues at Deutsche Bank called Trailstone, which is a energy trading merchant, basically, that was funded by Riverstone private equity group, and was there for 8 years until leaving to start 10Dynamics right before COVID. So I started the kind of week before COVID kicked off, which was an interesting time to start a business. But yeah, and that led me to here, basically.
Wow, wonderful. I love that story. So it's funny because my wife's a chemical engineer too. I always say that she's a smart one in the family, but
Yeah.
I'm lucky if I can tie my shoes.
Well,
So
yeah.
yeah, I love how you went from engineering to a PhD in finance. You've worked on it. Now you do systematic. There's two major schools of thought. There's discretionary traders slash investors or systematic.
Yeah.
Curious, did you start off as discretionary and then move to systematic, or how'd you end up
Yeah.
in systematic?
Yeah. I ended up, interesting. My PhD was really focused more on behavioral finance. And there I was looking at more kind of quant equity style strategies. So things like, different accounting ratios and that kind of stuff that was popular then, and the momentum strategies and what have you. And when I ended up going back to industry, I got hired to work, funnily enough, on the weather derivatives desk. So the weather derivatives desk back in this was in the Enron days. It was kind of a new idea that you could trade weather and hedge it. And there's still some weather futures around that people, use to speculate. And that was kind of a quasi quantitative fundamental role. So you had this nice overlap between, on the quantitative side, where there was some modeling and stuff that we did around weather, but then there was also the fundamental side, like how did weather play into demand and supply for energy, right? So you were combining the ability to trade weather with the ability to trade natural gas, let's say, and you could create some interesting portfolios based on different outcomes of those things. So really, I kind of used the PhD and the quantitative skills to start in that area, and that really then got me into fundamental proprietary trading in energy, and that was really what kicked off my career. So I used the quantitative tools more as a help because, at the time, certainly I felt like, fundamental analysis wasn't, and you wouldn't really call it quantitative, right? Because it's more like really, really fancy accounting, or a good job of counting things, counting demand or what have you. And then you get to see in certainly in the energy space, in power, you get to see the magic of microeconomics. Power is the one place where if you know what the demand is and you know what the supply is, you know what the price is. And so you get fascinated with the idea of, well, I can actually build a model and figure out what the price should exactly be based on if you know that what they call the stack, which is the different power plant production prices and where demand is. And then weather, of course, was playing a role in that. So that was kind of the initial, I guess, kickoff of my career, and then for a long time, was really focused on fundamental trading and proprietary trading off the back of that. But what was interesting, and this has happened over my career because I've been doing this for a while, is if you look from say 2000 to very recently, the Sharpe ratio that we could get off of bottom up fundamentals has been steadily being eroded. And that and it kind of makes sense because certainly I went to London, came to Europe in 2001, and Enron was there, and there were a lot of other energy trading companies, but this whole idea of fundamental trading wasn't really that well known. And so you could really get an advantage through modeling. There were definitely people who were doing better jobs modeling prices, but there was also, it wasn't like it was the beginning of the internet, but there was a lot of things that weren't readily available like it is today.
Correct.
Even things like in Europe, a lot of data that was supposed to be public, the agencies responsible for that data treated a little bit like a state secret. So, you had hydro power production data in France, for instance, that was really difficult to get a hold of because they really didn't want people to get a hold of, but it was still on the web, right? So you could get an edge through finding data that other people didn't have and doing a good job modeling, and also a little bit the structure, the way you build your teams with having these very close trader analyst type pairs that were very successful in generating outstanding returns. But then what happened is that model got to be pretty well known, and a lot of people, analysts actually after Enron went under, then a lot of analysts went to a lot of other places, and it became more common for people to have that setup. And then you reach the point where everybody's running the same models with the same data, so it's pretty hard to get an edge. You still can do it. There's definitely still value in fundamental trading strategies, and there's plenty of people out there doing it today. So it's still there, but I think the reward to risk ratio really shifted over time. And during this whole time, I've been building up my own tools based on my trading, that I was doing, and the managing of some of the trading desks that I was working with, that I thought were really useful in particularly around timing in terms of fundamental trading strategies. Because as it's the bane, I would say, of fundamental trading. You tend to be early, right? And that's the if things are low, you think, oh, this is as low as they can go, and well, it turns out they can actually go a bit lower, and so you tend to be early, and that's kind of the bane of the existence of fundamental traders. So these timing signals started to get more accurate, I would say, and help a lot with the fundamental trading. And then eventually, I reached a point in my career where I thought actually the systematic stuff was doing better than the fundamental trading. And that's when I kind of decided to switch my focus and really be just dedicated to, building out the systematic signals that I've worked on over my career.
I love that. So let's talk about your investment strategy. Can you please share with us what you do?
Sure. I mean, I guess it starts with a little bit philosophical, and I don't know if other people do it that way. And we had when I was in university, I had some experiences with kind of the real quant finance stuff, which is all, as you know, Brownian motion based. And anyone who's been in a class in finance will probably have a professor put up a chart and say, what stock is this? And then lo and behold, it's no stock. It's a Brownian motion, right? And it's supposed to show you. But what you don't know is if you actually go off and run 100 Brownian motions, that was a hand-picked chart, because 90-something% of those Brownian motions look nothing like you would ever see a financial market. So, I started to realize that statistically it might be a good model, but it wasn't a great model, I thought, to represent, because I'd had experience working in trading and finance before my PhD, that I thought, geez, this doesn't really ring true to me. And at the time, you had Mandelbrot wrote some books on fractals and was applying fractals to finance. And there, if you ran some simulations, what you got is stuff that looked a lot like price movements. And so I thought, well, okay, this just the old augmented eyeball test told me that this was more true state of the world than Brownian motion. So I kind of went down the rabbit hole of fractal mathematics for a while and trying to figure out if it was useful. And while I couldn't really find much, I mean, we could talk a little bit about one thing that I think is interesting, that does work, that comes straight out of it. It is a way of thinking about the markets. It's a little bit different because it really leads to how you analyze markets. We break all price movement down into linear segments. So we remove the noise from linear segments and basically say, well, the market went from A to B and then went down to whatever, and so it's these linear segments that move back and forth. And then we run, each one of our signals looks at those linear segments and compares them to the very recent past. So we'll look at if the market has moved up from A to B, you'd look from the previous bear market and then the bull market that preceded that, whatever, call it a market, but just a move. It could be as short as, if you're looking at a very, quick frequency time frame, like 30 minutes or something like that, then, maybe each move lasted half a day or whatever it is. It's dependent on the time frame, how long those moves last. So, how long you're looking back in time depends on the time frame you're looking. But typically, we don't look very far back in time. So we're really looking back just at the previous two moves. And so once we have those linear movements, what I kind of worked on was how can I characterize those movements into some fuzzy measurement of psychology. Just by going up alone is telling you something about the psychology, right? Moving up is telling you that the current psychology is bullish at that moment. And yes. But how it's behaving also really matters, because you can have a market going up and it can be going up in a very sloppy, choppy way, or it can be going up very directionally, or it can be going up in sort of an extreme volatility movement. And then you can compare that to the recent past and say, well, is this behaving just intuitively? Is this more bullish or less bullish than what happened in the past? And so we have these 10 signals that look at the relationships between those linear segments. And one of the things that we do is we don't, a lot of quant signals use distributions. So they'll look at like if you're going to do like a price to sales ratio or something, you get a distribution, right? And what I've found over my career is that I don't think there's a lot of information in those distributions. And I think you can fool yourself with the precision that you get from those distributions. And if anything, I've seen looking at different signals that you tend to get reversals in the extreme measures of some fundamental signals. So we do everything as binary. So everything is true, false. We have 10 true, false signals. So we basically say true, false. And that what the true, false is telling you is the psychology bullish or bearish, basically, based on the recent psychology. So each one of those measures, we look at, okay, is it true or false? And then we kind of let each one of those signals vote independently on different time frames. And then we aggregate everything up into what we call a confidence. And so it's a measure that goes between minus 100% to plus 100% and everything in between. And whatever that percentage is, well, that's what your position size should be for that asset, given the risk that you're budgeting to that asset. So it's kind of I wouldn't call it exactly non-parametric, but we're trying to take some of the over complication out of things. I think that I've seen in the past that haven't worked very well. So hopefully we're getting some robustness out of more simple approaches.
I love that. Simplicity in my world is key. If I can explain it to a 5-year-old or 10-year-old, then great. Stocks can only go up, down, or sideways after you buy them. That concept itself is just huge, right? Exactly. So any market for that matter, anything you buy. So that's simplicity. I'm all about simplicity. All right, beautiful. So it's a perfect segue to my next question. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
Well, this is where we do have another philosophy that comes straight out of kind of our, prop trading backgrounds. And that's, I really believe that your risk should be scaled according to your confidence. And that when you have low confidence, you should be running low risk. And when you have a high confidence, you should be running high risk. Now, that's counter to what a lot of people do. A lot of people have a specific risk budget and they're fully allocated all the time. Right. And for what we do, what we see is that is detrimental to performance, that you're much better off scaling within your confidence. So what we do is we create a risk budget for a portfolio. So whatever that is, it's whatever it's called a volatility target for your annual vol. We know, okay, given that volatility target, we back everything down into a daily risk measure, a VAR measure. We say, okay, so for example, if you want a 10% annual vol in your portfolio, we know that's about a 1.5% daily VAR for our VAR model. And we say, okay, so if we want to achieve that over time, that tells us how big our risk budget should be across the portfolio for all the assets. And then we equally allocate the risk for each asset. So each asset gets the same amount of risk budget. So for instance, what that means in terms of numbers is, giving the example before, if whatever the portfolio size is, you might decide, well, actually, we need to at most have a daily risk of, say, $100,000 on an asset, right? So that based on the volatility of that asset, well, that means you could trade 100 shares or 200 shares or whatever it is. So we know the max position based on the max risk. And from there, then we use our confidence to scale that max position. So if we have a confidence measure that comes out at 50% and the max position we could have is 200, then we'd have 100 shares of that, whatever that asset is. And so we do that across the whole portfolio. So it means all this within each risk budget, each asset's being scaled independently. And that means that our portfolio has a significant, we call it like breathing, but there will be times that, given that 1.5% VAR target that I mentioned, there will be times that we're running only 50 basis points of VAR for maybe a couple of weeks at a time. But there might be other times where the portfolio is actually running 3% VAR, so double the normal VAR. So if you think about the range from, say, 50 basis points to 3%, that's a very big risk range, much bigger than I think a lot of other people do. So that really works for us, and it comes directly from on the prop trading side, and anybody who does this will maybe be able to relate to it. There's times where if you have a fundamental, whatever your prop trading methodologies, but let's say it's a fundamental approach, there'll be, if you're lucky, maybe twice a year, but once or twice a year where you really know that you've got something.
Yeah, it's a fat
exactly.
pitch. Yeah.
And so, if you're a good prop trader, and so you get in there and you use whatever you think your max risk is, you're on it with that amount of risk, right? And, generally that's where you make all your money. But then what happens is that only happens twice a year. And there are very few prop traders that I've met in my career who can sit on their hands and do nothing the rest of the time. So what everybody ends up doing is they see something that they think is pretty good. It's always the thing. There's always a think in there. Oh, I think this might be a good signal. I think this might be a good fundamental. And then what happens is they end up taking a lot of low quality trades in the middle in between their big winners. And if you don't scale those low quality trades down, if you don't have the discipline to say, actually, I'm not as confident about this trade, I think I'll scale it down to what I would normally take, you're going to end up giving away all the money you made on your bigger positions and your better, your higher skill trades, right? So that's we've effectively built the model to do that implicitly, and it seems to work really well. And I think it's definitely an advantage for what we do.
I love it. So thank you for that overview. Now we're going to shift the conversation to one of my favorite parts of the show is timeless advice. So Bill, what are some timeless lessons you've learned along the way that you'd like to share with the audience?
Well, let's see. Well, the first one the one we just mentioned, that I think risk scaling is really important, and being, if you're investing or trading or whatever you're doing, talking to somebody else, because they will have other people can question what you're doing. It's hard for you to question what you're doing, right? So, having someone around who can help retrograde your confidence a little bit, I think is a useful tool. And so that's why, we did it pretty religiously in the trading organizations I've worked, where we would have, weekly meetings where everybody would discuss their ideas and debate, and analysts would bring information in, and traders would give their views. And that was really good. And the times where everybody was kind of on board and you could see across the room, that's when, good things tended to happen and you made a lot of money. So I think it's important to not only scale your risk, but to have a way of getting some outside influence on how you're doing that, because it's a pretty unique person who can do it all themselves. But yeah, that would be one for sure. Um, let's see, what other timeless advice do I think I could give? I mean, well, one thing too that I think it's good to know what kind of trader you are and philosophically, because not everybody's cut out to do certain types of. There's lots of ways to make money, basically, and not everybody is suited to every type strategy. And I'm not sure that people spend time thinking about what type of strategy do they want to use and what. Because if you're not comfortable with the type of strategy you're using, you're not going to. If you're going to allow yourself to make decisions about what to do with that position, you might not do the right decisions, right? So, knowing your style, I think, is important, and that goes back to just knowing what you're good at. Um, the real danger with, and this is, trading is very seductive, right? It has a little,
Absolutely.
it has a little, hook to it, and it's also really, really hard. It's really, really hard. And even if I look at over my career being in energy trading companies, banks, now hedge fund experience, there's a huge portion of people who make money because they have a given edge. So something else outside of them that they may not even recognize that helps them. So, trade, if you work for an energy company, let's say, you might have information that comes off the back of your portfolio, the assets in your portfolio, or the traders that you sit next to, or something that really helps you, and you're not even aware of that. So I think, having a really humble approach to trading, both in how difficult it is and how easy it is to fool yourself into thinking that you know a lot more than you do, I think is it's important to have that perspective.
Yeah, I love that. There's two thoughts that come to mind. The first one, to your earlier point, was personal blind spot bias. So in psychology, they call it a personal blind. You don't know, you can't see yourself objectively. An
Yeah,
example of that: ask 100 newlyweds the night they get married. How many, raise your hand if you think you're gonna get divorced. Nobody raises their hand. But statistically, we know half of them are getting divorced. So
yeah,
that speaks to that earlier point about getting outside objective. Two people playing chess, the third person can see moves they don't
yeah,
see. So I
yeah,
love that. And then the
yeah,
second one, the know thyself part and have an edge is just so powerful because yeah, I like to say, actually, I say in the book, there's an infinite number of ways to make money in the market. Your job is to find one that works for you
yeah,
because otherwise you're just lost. You're just, I
yeah,
give you the great system in the world. Everyone asks me all the time, hey, Adam, what are you doing type of a thing? It's okay. I can tell you,
yeah.
but are you going to be able to do it? And then that's the key.
Yeah. I mean,
So
in
I
my
love
career,
that.
I've seen traders who are good at a specific thing who try to train other people and pass on their knowledge and can't do it. And
100%.
because, and some of it is maybe because they have a hard time, if they're not doing something systematic, or they're not very not even just mathematically systematic, but systematic in their approach, it might be hard to teach people. But a lot of times they're teaching people how they see things and how they trade, and it doesn't fit the other person. And
Correct.
then, you can see it even with quantitative strategies. Like, before we got on, you asked a little bit about, secrecy and stuff. And part of the reason why I'm not so concerned about talking about what we do is every time I've seen anyone tell anyone else what they do, the first thing the person who receives that information does is twist it or change it or do something so that it fits them, and
Correct.
then are surprised when they don't get the same results. So
100%.
there's just this human nature. You see it. It's not just trading. You see it in, I don't know if you have any experience coding. Every time you write some code, you show it to somebody else, and their first response is, "Oh, this is awful. Somebody
Yeah.
needs to change this."
100%. Yeah.
You know, so everyone always wants to personalize what they're doing, and
Mhm.
so that's a big thing in our markets where you've got, um, as you said, 1,000 different ways to skin the cat, and how much of that is success is internal, and how much is what you're doing. Yeah, it's a pretty interesting question, really.
Thank you. So I love that. Next question for you would be the flip side of that. What are some mistakes you've made or some mistakes you've seen other people make, and how do you avoid them?
Um, well, yeah, I mean, it goes back to thinking you know something when you don't. That's definitely the number one mistake. I think uh, the self attribution bias is a real issue too. I think it's really easy, when and now it's almost like ingrained in me that when trading has been successful recently, I just know that there's some unsuccess coming around, because at the end of the day, the averages are the averages, and you're gonna average out to whatever your expectation is. And I have seen in the past, and probably even when I was younger, thought some great success was going to continue for forever, and that again leads you to over trading or over betting just because you've had a good run. And that's an easy mistake to make in the early part of your career, when you're just thinking, because it is so seductive. You just think, God, look at what I've figured out, and look how often it worked 20 times in a row. But yeah, the law of large numbers is always at work out there somewhere, and kind of teach you lessons. So
Funny when you've been doing this long enough and for decades, like we both have. This is the first time we meet, but literally
yeah,
as you're speaking, I feel what you're saying.
yeah,
Not even
yeah,
intellectually, I understand it from a deep down, from a personal standpoint. I've been there, I've made those mistakes, I've done that, and I know exactly what you're talking about. So, all right,
yeah.
love that. How about this, Bill, for the final question for you today? What's the
Mhm.
best piece of advice you'd like to give the audience or give your 30-year-old self?
Ooh, my 30-year-old self. Well, this is going to be controversial.
It
I
is.
would I I would tell my 30-year-old self to do something else, because this is really hard. And I
Yeah.
see I see, if I look in my industry in particular here in Europe, in the energy trading space, the guys who are successful today are the same guys who were successful 20 years ago. And younger people coming in really struggle to figure out how to be successful. If they're not given a real edge at a company that has some sort of advantage over everyone else, that gives them an edge where they can grow and become successful and learn the game, I think it's really tough. It's a really tough business, to come in. And if somebody said, "Oh, here's this amazingly talented person, teach them to be a trader," that's just different from what we do. What we do is sort of just. I'm not a trader anymore. I view myself as a mechanic. I've got a machine, and I just make sure the machine keeps running. Right. I don't really care about the markets,
Right.
but to try to teach somebody young to be successful in this, and when you see people talk. If I've got three young sons actually who are in their 20s, and they'll ask me
Nice.
stuff, and I think, gosh, the education hurdle is so big, and there's not even its experience hurdle is so
It
big,
is. Mhm.
and so yeah. So if I was 30-year-old self, I might say, go be a doctor. So I don't know what I'd
I
say,
love
or
that.
maybe yeah. But now I guess I almost feel like more of an IT person, because we did all our own coding and everything. So definitely have shifted my career a bit, but
Bill, thank you so much for taking the time to speak today. It's
sure,
been fantastic. What's the
absolutely.
best way for people to learn more about you or get in touch or
You
dive
can
into?
come through our contact page on our website. So it's 10dynamics.com. And you can click the inquiries button and send us a message, and we will get back to you for sure.
Beautiful. Well, thanks, Bill. Have a great day.
Thank
Hope
you.
we'll speak to you again
Cheers.
soon.